Let me start with a story that sounds like a myth. About 400 years ago in Holland, a wild frenzy swept the country. Back then, the hottest investment? Not gold, not land, but a flower. At the peak of the madness, how high did the price of a single rare tulip bulb climb? High enough to trade for an entire mansion by the canals of Amsterdam. People traded these bulbs like crazy. Nobody was buying to grow flowers. Everyone only thought, I buy it today, and tomorrow I sell to the next person at a higher price. Until one day in 1637, the bubble burst. Overnight, prices crashed to just 1%. Countless people were ruined. This is top-tier logic. I'm Mojo. We see through the logic of money, because wealth is the only chip, to real freedom in this brutal world. Today we're talking about two things that have haunted humanity for centuries: inflation and economic bubbles. We often complain prices keep rising, yet we rarely ask why prices never come back down. Today, I'll help you see through the two invisible hands behind it. First, the first hand. Overissuing currency. This is the hidden force prices. The logic is simple. When goods in the market don't increase, but the cash in circulation does, then each bill buys less. This is purchasing power being diluted. There's a great book called How an Economy Grows. It gives a vivid analogy. An island uses fish as money. Later, the government, to cover its spending, secretly cut each fish smaller and stitched it into a smaller official fish, then told everyone this is still one fish. The result? The islanders had to spend more of these official fish just to buy the same filling portion as before. This caused two things. First, the real purchasing power of money kept shrinking. Second, prices could hardly fall back because the official fish never grows bigger, only smaller and smaller. You think this is just a fable? Look at Zimbabwe. Around 2008, the government printed money madly to fill the hole and finally printed a note worth 100 trillion. But this 100 trillion might not even buy a loaf of bread. When currency is overissued to the extreme, the money in people's hands becomes waste paper overnight. After printing, let's look at the second hand. Low interest rates. This is the breeding ground for asset bubbles. To stimulate the economy, politicians' favorite move is cutting interest rates. Once rates drop, the cost of borrowing falls, so people withdraw their savings and eagerly borrow from banks to invest. This floods the market with hot money. Where does this hot money go? It rushes into real estate and stocks, blowing asset prices higher and higher. The most classic example: in the late 1980s, under ultra-low rates, Japan's real estate prices soared to an unthinkable level. There was even a saying back then that the land under Tokyo's Imperial Palace alone was worth enough to buy all of California. The whole nation fell into a collective illusion that house prices would rise. But the result? The bubble burst in 1991. Prices crashed all the way down. Japan's economy fell into a 2 to 3 decade stagnation called the Lost Era. When an asset's price far exceeds its actual value, so why can a bubble be blown so big? That brings us to the third point: leverage plus herd mentality. Economic bubbles share one trait. People buy something, not for its real use, but purely to gamble, betting they can sell to the next, greater fool at a higher price. In economics, this has a vivid name: the greater fool theory. As prices keep rising, a powerful fear of missing out drives more and more people who know it's unreasonable, yet still chase blindly with their eyes shut. This is the herd effect. People see others charge in, so they charge in too. And what truly turns a bubble into a nuclear bomb? Before the 1929 U.S. stock crash, the market was euphoric. How did the speculators play? They used only 10% of their own money, the other 90% all borrowed from brokers. Think about it. If the stock rises 10%, his capital doubles, 100% gain. This windfall made everyone go bloodshot with greed. But leverage is a double-edged sword. It can magnify gains tenfold and magnify losses tenfold too. A mere 10% market drop, and these people trading on 90% borrowed money see their capital wiped out instantly, even ending up deep in debt. And this leads to the cruelest, the bursting of the bubble. A bubble can't inflate forever. When someone in the market finally calms down and realizes this thing isn't worth its sky-high price, panic spreads like a plague. People start dumping frantically, prices plunge, and once prices fall, it triggers broker margin calls, forcing the leveraged ones to sell their assets at any price to repay debt. The selling pressure drives prices down further, and the drop triggers even more margin calls in selling. And so forms a death spiral of falling prices, forced selling, and falling again. The Black Thursday of 1929 was exactly this. The market lost nearly 90% of its value over the following years. Countless firms collapsed, and 1 in every 4 Americans was unemployed. This was the Great Depression. And an almost identical script played out again in 2008. Cheap loans blew the U.S. housing market into a giant bubble. As more and more people couldn't repay their mortgages, subprime loans began to collapse, eventually becoming a financial tsunami that swept the globe. By this point, you'll find one objective law that runs through centuries and never changes. This is the 5th point: the wealth reset under economic cycles. From tulips to Japan's housing to the subprime tsunami, the birth, swelling, then bursting of a bubble is a constantly repeating cycle. And every bubble burst isn't the disappearance of wealth, but the redistribution of wealth. In the late stage of a bubble, ordinary people who chase blindly, buried in huge debt, often become the last to hold the bag. When the crash comes, they lose all their savings. But those masters who see through the cycle, in the moment everyone is most insane, stay calm instead, holding cash, waiting patiently. When the bubble bursts, everyone panic sells, and quality assets are dumped at fire sale prices. Only then do they step in calmly and scoop up all these good things at rock-bottom prices. After one crisis, the poor are ruined, while the rich complete yet another leap in wealth. History doesn't repeat, but it always rhymes. So, back to that tulip at the start, the one that could trade for a mansion. Once you understand all this, you'll see prices never come back because the printing press never stops, and bubbles burst again and again because the greed and fear in human nature have never changed in centuries. Starting today, when everyone around you is going crazy over something, all telling you this time is different, please calm down and ask yourself one question. Does its current price really match its value? Don't let yourself be the one holding the last baton. See through the cycle, respect the risk, and you can stand on the winning side in this repeated reset of wealth. If this episode helped you, please subscribe to Top Tier Logic, hit like, and ring the bell. Next time, we keep uncovering the logic behind wealth. I'm Mojo. See you in the next one.